I have a few things to say about mutual funds to complete chapter 4. And basically, I just want to go through, first of all, the advantages of a mutual fund compared to, let's say, buying stocks directly. Remember, if I want to purchase shares of Apple myself, it's going to cost a lot of money. It's going to be a lot more expensive for me to diversify buying stocks directly. A mutual fund would allow me to easily and quickly diversify without spending a great deal of money. But it doesn't give me direct ownership in a company's stock or a bond. Um, Rather, it's indirect ownership. So, the advantages of using a mutual fund: first, there are low minimums to become invested. But I'm going to phrase that as low minimums to open an account and purchase mutual funds. Van- Vanguard has a minimum of $3,000. So that might be a bit much for some of you, but there are other investment companies like Charles Schwab has minimums. I've seen 1,000 minimums, but I've also seen minimums as low as 100. Although it doesn't have that many funds that you can buy in with only $100. So there are ways to purchase a diversified group of stocks or bonds with very low amounts of money. The way to tell how much money is needed to purchase a fund, if you go to Morningstar, right now I have the Vanguard Total uh, International Stock Index Fund open. If you go to purchase and the initial amount is what you'll need to actually open your account. But then if you want to add additional money to your account, that's this number. So you can see this is interesting. I've never seen it as low as $1. So you don't need much money if once you open your account to add more money to it. You could put in $10 a month if you wanted. And then AIP stands for Automatic Investment Plan. So if you agree to automatically have money deposited, let's say once a month or once every 2 weeks, then you'll need 3,000 to open that sort of account, and then you only have to add a minimum of $1 for every automatic payment that you have placed into that account. And then let's look at Charles Schwab. Um, so this, I hope it took it. Um, this particular account with or fund with Charles Schwab is equivalent to Vanguard's total stock market index. It's a U.S. based fund, whereas the other one that I just looked at for Vanguard was an international fund. But the initial buy-in for the Schwab to open an account is only $100, and they're not specifying any minimums for those others. So again, it doesn't take a lot of money to get started. This isn't a bad fund at all. It's got very low fees. They're actually lower than Vanguard's total stock market index fund. And return wise, they're almost identical. There's also the potential for excellent diversification with just the purchase of several different funds. Morningstar has this neat website that they call an X-ray. And what you can do is input the ticker symbols of the funds you're interested in, or you can also add individual stocks. So I'm going to do the Vanguard Total Stock Market Fund. That's supposed to diversify you nicely across the US stock market. And then I'm just going to say I've got $10,000 in that fund. And then I'm going to do the Vanguard uh, International Stock Market Fund. So again, very similar to the one I typed above, but this one diversifies you across different countries outside of the United States in their stock markets. So I'm going to put just 10,000 in that one. You have to enter a dollar amount to get it to actually run. And basically, I'm saying I put an equal amount in each of those two. And so I'm going to show the x-ray. So owning this particular fund, I looked up this data earlier. The international fund has about 5,600 stocks in it, and then the US based fund, it has about 4,000 stocks in it. So just by owning shares in those two funds, you would indirectly have ownership in about 10,000 different companies' stock. And it's fairly diversified. It's about half in US stocks, half in foreign stocks, but the foreign stocks aren't concentrated necessarily in a specific country. Down here, you can see that, yes, a lot are in North America, 16% in developed Europe, 7% in the UK, about 10% in Japan, 4% in developed Asian market, 4% in the emerging market. So it's diversifying you. I don't think these two funds would be entirely sufficient to be what I would call well diversified, but just with the purchase of these two funds, you can be nicely diversified. And you diversify it across different sectors as well, which is what I'm trying to highlight over here, but not doing a very good job of it. Over here in the sector section, they've got low expenses. The average expense ratio of those two mutual funds is 0.2%. Basically, that means what they try to do is estimate the mutual fund expenses, and I'd have to look at how long of a time period they cover. It might be 5 years. I'm not quite sure. But they estimate that your expenses would be $39, probably on a $10,000 investment. I'd have to look up that, but they're very low fees that you would pay. But again, I don't think it's extremely well diversified. It's only got 6% in small caps, and that might be enough for you, or it might not be. So if you wanted more small caps, you could add perhaps an international small cap fund or an American based domestic small cap fund. But it is nicely balanced across value, core, and growth. So what I'm trying to get at is you can very easily and quickly diversify from only owning a few different funds. It's going to take a whole lot more money to do that if you buy stocks individually. All right, if I can avoid paying commissions, I don't have to have a brokerage firm place this order for me. When I buy shares of a mutual fund, you you can buy them directly from Vanguard or directly from Schwab. You have to open an account with Vanguard, but that only takes maybe 15 minutes or less. If you've got information like your social security number and what bank account you want to transfer money out of and stuff like that, it doesn't take long to open that account. So you can bypass a stockbroker, and that will make it so that you don't have to pay a commission. When I make a trade with my stock account, my broker charges me a $9.99 commission on every trade that I make. So if I wanted to buy 100 shares of Apple, it would cost me the money to buy the shares plus $10. If I wanted to sell half of them, I'd have to pay another $10 to do that sell transaction. When you trade mutual funds, trade is not the correct word. When you buy or redeem shares of a mutual fund directly through the fund itself, you don't have to pay a brokerage commission. Now, some funds charge what they call load fees, but you don't want to choose funds that charge that. That's the subject of Chapter 9, so I will talk about that later. Y'all may have heard of no-load mutual funds. Those are the types of funds that you want, but not just any no-load fund, specific ones, and I will explain that later. When I'm ready to cash in my shares of my mutual fund, the mutual fund must redeem them for me. So I'm going to capitalize that. They must redeem my shares when I'm ready to cash them in. If I own shares of stock directly, it's actually easy, fairly easy for me to sell those through my brokerage firm, unless it's a really unpopular stock or doesn't trade very much. It might be difficult for me to get rid of it. But with my mutual fund, basically at any time, the fund must stand ready to redeem my shares for me and give me cash in exchange for my shares. Sometimes they may have redemption fees or what they call deferred sales fees. I'm not sure if I'm spelling that right. I guess I am. And we want to avoid those. Again, that's the subject of Chapter 9. Mutual funds are also rather convenient. I have an account with Vanguard. That gives me access to all of Vanguard's funds, and they have several hundred of them. So I can open a single account, and that gives me access to all of that investment companies, in this case Vanguard, but it could be any of them, mutual funds, and actually exchange traded funds, which I haven't talked about yet, but I'll talk about that later in this lecture. They also offer the option to automatically reinvest any dividends. Let me pop over to uh, some sites show different information a little more easily than others. So I'm Vanguard is very nice to show you the dividends that a fund might pay. So we'll do the Vanguard Total Stock Market Index. Oops. And I'm just going to go for the past 5 years. In these blue diamonds, if I hover over it, it shows the dividend that was paid. So you can see they've been paying dividends around 12 or 13, 14, 15, 16%. Sometimes at the end of the year, they'll pay a larger dividend. I'm trying to get to December. Uh, that must be it. So and you can see in December, they paid a larger dividend. I'm going to pop over here to this December too. So they tend to pay a dividend of about a quarter. That's per share. So if you owned 100 shares and you got a dividend of a quarter, then you'd get $25. And they can either just deposit that in your account and it'll sit maybe in a money market fund, or they will perhaps, or they will not perhaps, at your request, give you the option to have the dividends and any other distributions automatically used to purchase additional shares. So they call that automatically reinvested. So reinvested in more shares of the fund that paid the dividends, or you can specify a different fund's shares be purchased with those dividends. And that's just really convenient. That means I don't have to do anything other than just tell them, yes, please automatically reinvest my dividends and distributions into shares of this particular fund. With a stock, you are not allowed to purchase a fraction of a share. I'm actually going to open a new one of these. So let's look at Google. Google, one single share of Google costs $645.44 right now. It could cost more tomorrow or less tomorrow. We don't know. If you only have $100 to invest, you can't afford to buy even a single share of Google. So Google's just out of your price range. If you want to directly own it, you cannot. But you can buy a fraction of a share of an index, or actually of any mutual fund. So if you only had $100, you could actually afford to buy slightly more than two shares of this particular particular fund, because it only costs $49.75. If you only had $25 to invest, you could buy about a half a share of this particular fund. So that's a nice feature. You can buy a fraction of a share of a mutual fund. You cannot do this with a stock. You cannot do this with an exchange traded fund. But what this allows us to do is invest small sums. So if you've only got $25 and the mutual fund allows you to contribute minimums of such a low amount every paycheck, let's say, you can still do that. So I hear a lot of people say, I just don't have the money to get started. Well, it takes $100 to open an account with Charles Schwab, and then you can put in just $10 a month if you want to. You can get started. If you've got questions about a specific mutual fund or how the process works, you can call customer service and they will walk you through things. It's a little more difficult to, I can't call my stockbroker and ask my stockbroker to choose a good diversified mutual fund for me. My stockbroker doesn't work like that. I use a discount stockbroker and they don't offer that kind of service. The mutual fund will also offer record keeping for me. And so does my stockbroker, but it's extremely handy at tax time. When you're having to deal with taxes, you have to have a record of how much you paid per share to purchase stock or a fund. When you sell shares of stock or you redeem shares of your fund, you need a record of how much you received for it. If you received any dividends or distributions, you need to know how much that is. You'll get a form from your mutual fund company that presents all that information to you. And then lastly, there's just a ton of variety with mutual funds. There's stock-based ones, there's bond-based ones. With stock ones, there's funds that are focused on large cap stocks, small cap stocks, foreign stocks, domestic stocks, stocks that pay dividends, stocks that don't pay dividends, stocks in emerging countries. Oh gosh, stocks that are value based, stocks that are growth based. And you have that same kind of focus with bonds. Well, actually, let me say, or you could buy a fund that's very broad. It's got thousands of stocks in it and covers the entire breadth of the market, like the Vanguard Total Stock Market Fund. You have the same situation with bonds. You can buy a very, very focused bond fund, or you can buy a very broad bond fund. There's a bond fund out there from Vanguard that has about 17,000 bonds in it. It's extremely broad across the U.S. market. I unfortunately can't remember how to pause, so I've got to look something up. And normally I pause when I do something like that, and I can't remember the keystrokes. So the next topic is exchange traded funds. I need to give you a little bit of history, though, about them. To buy a mutual fund, and I'll go ahead and use the Schwab Total Stock Market Index Fund. It doesn't really matter which one I use. It's giving us a quote, and you see right above the quote, it's got this NAV. I can't, there we go. NAV stands for net asset value, and it's actually per share. So it's the value basically. If I go over here to portfolio and holdings, if I take Well, we can see that they own 1.1 million shares of Apple, 1.5 million shares of Microsoft, and so on. If I take the number of shares of they own of Apple times Apple's current price, and then the number of shares they own of Microsoft times Microsoft's current price, and the same for all the other thousands of companies that this particular fund owns, because it owns 2,500-ish companies. If I calculate that value for all 2,500 or so companies, I will get um, well, that's part of the process of calculating the net asset value. So I take the total value of all the assets owned by that fund, and I subtract any liabilities that they might have. So if there are people who have said, we want to redeem our shares, but they haven't yet redeemed them, or if there are any other expenses that the fund has, they would have to subtract that from all the assets values. And then they divide all of that by the number of shares that exist in the mutual fund. That gives the net asset value per share. Sometimes you might see a PS after that, which stands for per share, but a lot of times they don't put that. This value changes every moment that the stock market is open, because the shares of Apple's their number of shares that they own of Apple might stay constant, but the price of Apple's changing. The number of shares of IBM they own might stay constant, but the price of Microsoft is changing. So this value is constantly changing. Therefore, they only do transactions once a day after the market is closed. So to buy or sell, or I'm going to call that redeem. So to redeem doesn't mean buy. Redeem means to sell. So to buy or redeem shares of a mutual fund, you must do this at the closing net asset value at the end of the day. So let's say I wire some money to the Schwab fund that we were looking at, and the money arrives at 10 a.m. And some of you sent checks through the mail, and they arrived at Schwab later in the day. And let's say over the course of that day, the stock market did well, and so the value of the shares rose over the course of that day. If they had bought my shares at 10 a.m. when they received my cash, and they had bought yours at 2 p.m. when they received your check, you'd be frustrated because you'd have to pay a higher price than I did if they didn't work the way that they do. And the way that they do is they get all the cash that was sent in that day, or they received that day. They wait until the market's closed and they calculate the closing net asset value. And then all of us will receive the same purchase price for the shares that particular day if our money arrived the same day. And if the stock market kept going up throughout the day, all of us would be frustrated because my money arrived at 10 a.m. when the price was a little cheaper. Your money arrived at 2 p.m. when the price was a little cheaper than when it was at close. But we'd all be charged the higher net asset value at the close of the day. So that frustrated a lot of investors. And so in the early 1990s, the American Stock Exchange developed what are called exchange traded funds, or, and I'll just call them ETFs. That can also stand for electronic. Oh, actually, no, it doesn't. So it's just ETF, exchange traded funds. Sometimes you'll see EFT, which is electronic funds transfer, which is something completely different. Essentially, ETFs are mutual funds. They're not technically a mutual fund, but they're similar, very similar to mutual funds. But they're mutual funds you buy through your stockbroker. for the most part. You can purchase some ETFs through companies like Vanguard. Vanguard's mostly mutual funds, but Vanguard has a collection of ETFs. You can buy Vanguard ETFs directly through Vanguard and bypass your stockbroker. But there are thousands of ETFs that you couldn't buy through Vanguard. If you wanted to buy those, you'd have to either open an account with each company that sponsored them or buy them through a stockbroker. If you purchase them through a stockbroker, you'll generally have to pay a commission. However, there is a limited list of ETFs that are commission free. For instance, I use TD Ameritrade as my stockbroker. They have a list of 100 ETFs that if I purchase those through Ameritrade, I do not have to pay a commission on them. 100 is not that many, and not every stockbroker has the same list of 100. Some might only have a dozen that you can trade commission free. I'll post a link to an article that I read. It's probably about a year old by now, but it has a list of different brokerage firms in which ETFs are commission free. And that's nice to have it commission free. If it cost, if it cost $100 and I pay a $10 commission on it, that's a hefty fee for the amount of money that I've invested if I only buy one share at 100. So I don't want to pay a $10 commission on a $100 investment. That's outrageous. So I would focus on, if I didn't have a whole lot of money to invest, those commission-free ETFs. I cannot buy a fraction of a share of an ETF. So let's go look at an ETF. To find that quote, I would need to look at Yahoo. Actually, Morningstar has some ETFs too, so I don't really need to use Yahoo. One, probably perhaps the best known ETF is called a spider, and basically this emulates the Standard & Poor's 500. It's very similar to the Vanguard 500 index. To buy one single spider costs me nearly $200. So if I only had $100 to invest, I could not buy this spider. There are several thousand ETFs. Some of them are broad based, like the spider. It's equivalent to owning 500 shares in 500 different companies. Although you're not considered a direct owner, you're an indirect owner. But there are those that focus on specific sectors. There are those that focus on specific countries. So very similar to mutual funds. I'm just checking my list of things that I wanted to mention to make sure I didn't forget anything. So basically this course is is and I am very supportive of people diversifying by investing in mutual funds and exchange traded funds and focusing on no load mutual funds, index funds specifically, that have extremely low management fees. These ETFs also have extremely low management fees. I'm going to find the spider on Morningstar, and I'm going to show you the expense ratio. Perhaps. So the expense ratio for the Vanguard 500 is 0.17%. Again, I'll talk more about fees in a later chapter. I, I don't know that this is actually going to pop up. The expense ratio on the Spider ETF is 0.09%. So it's even lower than the Vanguard 500. So ETFs are certainly a consideration. You should pay attention to those. Don't focus just on mutual funds. There's nothing wrong with ETFs within a certain subset of ETFs. So some ETFs, although not many, are actively managed. I wouldn't recommend those. I'd recommend the passive ones, and I would recommend a subset of those that's going to result in your being very nicely diversified across different asset classes if you want, or across all asset or subcategories of stocks, for instance. So small caps, large caps, emerging market, developed countries, etc.